How are you now? James Whelan here, VFS Group, on a extraordinary rainy day in which I have been requested by people to just redo my presentation from the webinar last week, which I did, and just my little bit just to go through the themes and everything that I'm seeing. Keep in mind this is probably pretty old. I do apologise for the clothes I'm wearing, the VFS, the branded merch hoodie. I'm freezing in my office because I don't want to turn the aircon on, but it is a very, very chilly day. So I apologise for my appearance out here today, but that's just how it goes. Look, I'm just going to get into the presentation which I did last week, and this was with David Scutt and Blair Hannon. I had Josh Chiat from Stockhead as well. And they really provided a lot of insight. This one, I'm just going to do my slides and just say what I'm seeing, where I'm going. Keep in mind this is about a week ago, and when I made it, it was about a week and a couple of days ago. So there was actually sort of before the real seriousness of this, what we've seen as a correction, actually started to take place. That aside, I'm just going to go straight into it and just launch. Right, here is the presentation. The VFS Group Quarterly Update 2023 Q1. Can we come out now? Obviously, you know that my presentations are raw. I've also got coffee, excuse me. Black, that's Nescafe. I just really just get into it. I don't like to do flashy slides or anything like that. I just do the presentation. So look, this is just the straight up one. First off here, Elon Musk, I apologise for that, but it's so funny how in a year things can change so rapidly, from him being the hero of the world for some people to then all being one of the most disliked and despised people that's out there. I've seen a few troughs, and we'll get straight into it. Disclaimer, this is all general advice. You already know that's the situation. Right, straight into it. Now, we estimate that given our terminal rate forecasts, the average outstanding variable rate mortgage will rise to 7%. Now, this is out of the ANZ numbers, I think. Fixed rate mortgages will delay some of this impact, but the peak switching period is approaching in 2Q 2023. We estimate that the further 50 basis points of further rate hikes we assume will increase servicing costs for the aggregate household sector by 70 basis points and see it rise above its prior high recorded in 2008. For the average mortgage holder, increased servicing costs represent an 8% income headwind relative to a year ago, while for a more highly levered borrower at 6 times debt to income, which is 22% of lending in 21, was above this threshold. So 22% of people were above this threshold of 6 times debt to income. Hello. Repayments will now require half of their income. Guys, I cannot stress enough. Hello. I cannot stress enough how much this arrow pointing up there really is going to impact the Australian economy. I'm staying with the local stuff here, and we're talking about mortgages. So we're seeing these are the fixed rate maturities that are going to go to variable, and we're talking numbers that all of a sudden it's going to be hit like a slap in the face of people saying, "Oh, I was fixed at 3% or wherever I was fixed at 4%." Fantastic, and then now you are fixed and you switch to variable. And it's at a number which is higher than the number that APRA told the banks that they needed to assess you at. People already know what's coming up. Now, here's the thing. People are saying, oh, it means that the banks' stuff means that everything is going to go wrong. I don't think that is the case. I know people too well. I know I've done well in this industry. I've done well in this business to know that I'm good at knowing what actually motivates people. Probably a lot better than, definitely a lot better than I can actually deep down and get into the valuation of an individual company and the intricacies of that. I know better about the way that people react and the way that people respond when they're faced with certain things. The first check that you sign is always the mortgage check. With your pay, it goes straight into there. It means that you cut everything else out. It means that you go from shopping at the expensive groceries to all of a sudden then you go to Woolies, and then you go down market at Woolies, and then you go to Aldi. You know what I mean? And then eventually you just cut a whole bunch of things that are out of your life. But you always make that mortgage bill. There will be people who don't. That's always the case. But this is just one of those things. This is the way that I see it as being. It means that I'll get to the next bit. Hang on, I'll get my face off the screen as we go. Next slide. Consumer confidence is falling. So now look at where this is. So this is the ANZ Roy Morgan Australian Consumer Confidence. It's dropped 5.5 points to 78.1, lowest level since early April 2020 after the RBA raised interest rates by 25 basis points. Average confidence amongst those paying off their home fell by 10 basis points. Thank you, Adelaide, for that note there as well. Look over here. We've got, this is us here. This is just consumer confidence. It's obviously coming off. It is obviously coming. for the reasons that I just told you. No surprises there. Australian retailing. Let's have a look at some of the big numbers that are out and about on this one. I'm not going to open up any of the research that I've got attached, but there's some amazing notes that are along here. Macbank, Citi, and Westpac putting out some good notes. Consumers remain intensely risk averse. So this is the Westpac note. This is out of the Westpac Red Book. And they run the Westpac Risk Aversion Index, lifted from. So this is the Risk Aversion Index. It's exactly what you think it is. It went from 50.2 in September to 51.6 in December. Second highest read on records, back to 1974. Wow. June 2022 was the highest for risk aversion. June 2022 was the highest for risk aversion. Yeah, everything was collapsing. Yields were going up. Bank deposits, pay down debt were the highest, favoured over shares and real estate as the wisest place to put your savings. Bank deposits, pay down debt. That's the two places people are going to be putting their money, as opposed to shares and real estate. There's a choice that you've got to make. It's not going to be investing in the stock market. It's going to be paying your mortgage. It's going to be chucking it into savings if you can. Good luck to you. So our consumer sentiment measures have been flashing red. So this is this number down here. Our consumer sentiment numbers have been flashing red. So this is right here for some time now, and notwithstanding the resilience of spending through much of the second half of 22, an abrupt near-term slowdown in spending now looms. That is some good coffee. This is not some good data. So this is sort of that line in the sand where this sort of marks. It is going to say that, look, everything goes downhill after this, right? And then it comes back down to this sort of spot that we're looking down there. Won't be as bad as potentially we've seen it before. However, risk aversion is definitely on the horizon. Now, we'll talk about Australian retailing. We released so this is the Citibank outlook for retailing. They canvassed their many investors. The first and largest group still expect a significant correction in retail by the middle of the year. I cannot agree with that any stronger than that. I got to hammer through this because I realise that I'm stressed for time. Now, where does this leave us? Now, it means that retail is stuffed. Cactus, whatever you want to say. I would not want to touch Australian retail with a barge pole, 20 foot, 50 foot or otherwise. I think that if you hold it, that it would probably be a good idea for you to start rethinking that position that you've got right now. When it comes to the cuts that people have to make, that has to be the first to go. We've had a great couple of years, kids. That's just... This is literally the conversation. Guys, it's been a couple of great years. You've got some amazing presents under the Christmas tree. We've had a good couple of years at home. Yes, there might have been some fighting. We're all human. But we all got along. We all lived and survived through it. And now, guys, seriously, we've got to pay the bill. Got to pay the debts. We're sending you to school. And that's enough. So maybe Christmas this year won't be as amazing as it was last year or the year before. But at least we have our health. Whatever you want to say. Okay, so, but these are the conversations that are happening all over Australian families, and it's just that pressure point. It's going to be the simple example that I make is about pizza. We went from, hey, COVID finished. We went out for pizza on Thursday and Friday night, or Thursday and Saturday night, or whenever, Monday and whatever. And now maybe we just do that on Friday nights. We'll just go out to pizza on Friday nights. Actually, now, guys. We're just going to order in pizza. It's going to be great. We'll sit here and watch a movie. Football's starting soon. We'll watch the footy and we'll order a pizza. And it's going to be great. And then eventually it's just like, I bought a pizza from Woolies. It's this really nice one that we got. Or I got one from a really nice sort of place. And we're going to cook it ourselves and it's going to be fantastic. And then you go, look, I've got this other sort of pizza that we got. It's the simple standard pizza. And then eventually it's just, we're just going to make our own pizza here at home because it's just... And you see the way that people downgrade these things. All of these things are destined to, we don't miss our mortgage payment. We don't miss our rental payment. We don't miss these things. Australians don't miss these things. We don't just put the keys in the letterbox and walk away. Well, we can't. It's not America. Okay. Now, moving on. Quarterly earnings. We are in an earnings recession in the States. Don't be fooled by any beats. Don't be fooled by any nonsense that you see in any way at all. The quarterly earnings changes are coming off and have been coming off. Year-on-year estimate for quarterly earnings over time, absolutely coming down. See down here. Now, we are in an earnings recession. Don't be fooled. What does it mean? Well, it means that, okay, we're getting small percentages of beats. Half companies reporting earnings that are in the aggregate. So this is about a week and a half ago, right? So just take it easy. Companies reporting half of the companies reporting earnings that in the aggregate 1.1% higher than analyst expectations. Keep an eye on the fact that those expectations were already downgraded, so they've beaten expectations just. However, this is a bad result for two reasons. This is according to FactSet. One, the FactSet notes that an aggregate 1.1% earnings beat amount ties the all-time worst quarter for this metric. So beating by 1.1% is the worst that's ever happened. Back in Q1 2020, at the onset of the pandemic, all the way back to 2008 financial crisis, it is materially lower than any of the other stuff. Don't worry about that. Skip that. 60%. So this is when 60% of companies had reported of the S&P 500. 70% had beat EPS. Usually it's 74%. The aggregate beat is only 0.6%. Revenues are up 4%, but earnings per share, here we go, earnings per share is down 5%. Why are earnings per share down 5%? One entire percentage of that is margin compression. Margins are getting squeezed in US companies. That's pretty significant. Let's have a look at some margins. Look at that. Coming down, right? 13% was your net profit margin. I'm not going to show you how to calculate net profit margin. Just imagine that the bit that you've got from the top line of making money in versus what you've got to put out, that's how much you're making. So that's 13% down to 12.8. Anyway, 11.4% is your net profit margin. Down to the lows. We haven't seen things that bad since the pandemic, really. Look, it's not life-threatening. However, margins are a company's lifeblood. And here's a little interesting view, which I've got. And I've got a quote off an anonymous Twitter account. He's actually a pretty smart guy. Going to be sickly funny when corporate caution on staffing levels in order to protect margins is what causes the economy to turn down rather than the rates-led demand hit that isn't coming. The Fed has been trying for ages to get a demand reduction. It hasn't worked yet. Maybe it's going to be listed companies trying to protect their margins and getting rid of people and making things worse is actually going to be the thing that kills the economy, which is exactly what the Fed wants to do. So it'll happen, just it'll happen indirectly. But look, this is not a laughing matter. Margins are important and companies will do what they have to protect them. I'll show you how to invest accordingly. Really quickly, the forward 12-month price to earnings ratio is back up to its 5-year forward 12-month moving average. So it's average, it's 5-year average, so it's back to its average. When I snapshotted this one, now prices have obviously changed since then. This was me saying, and I did TV a few times, just saying the market is officially fairly valued. It's not overpriced. It is definitely not underpriced. It's about where it needs to be. If it now comes off, and this is me, here I am, Nostradamus over here. If the market does come off from here, I wouldn't be surprised. It was difficult to see it really pushing on with any real severity. From there, this coffee is getting cold. So, where do I like the trades? My face? Hello, how's it going? Sidelines. Be on the sidelines and short consumer discretionary. Keep in mind, this is a week and a half ago. I'm going to stop saying that. Definitely in Australia more than in the US. The US consumer is actually quite robust at the moment. So, don't stay away from there. However, we saw some reports from... so Walmart, I think, was actually quite strong. Well, not strong, but I think that it had some good shining lights in it with regards to where people are going to shop. We're seeing that trend move of people shopping downgrade. So go to your cheaper places. I think that Woolworths is a great example right now locally of a stock that you probably want to own as we go down that path. People still need to eat. They won't cut out eating yet, but they will shop cheaper. So that's spending habit. That spending pattern will go into those places. So places like Walmart, Home Depot, interesting with a very interesting take, just saying people have got in the US, people have got their mortgages fixed in. They're under no obligation and they're under no inspiration to move. They're not going to go and get a new house. Definitely not going to go and build a new house, not with things as expensive as they are. And so if you're not going to build a new house, you don't need any of the Home Depot stuff. It's that simple. Don't overcomplicate it. Anyway, and be a part of long quality. I'll talk about that in a second. Be a part of the range if you can maintain the focus. So this is me last week before the correction. Obviously, it's stupid. It will go up. Then there's going to be talk about the Fed is going to ease. So then the market will start to sort of ease back in. It goes to a certain point. People are saying, inflation is actually running high. The Fed is going to have to keep on going. And we will get this continual sort of streamy flow for probably until the end of the year. We'll finish off where we started the year. That's my view anyway. Why quality? Now, this is quality. Quality is actually a factor ETF that you can get. It is actually a way of investing. They do the scans on quality. QHAL is my preferred here. It's hedged quality ETF. The short answer, why quality? Why quality? Why not? Why not quality? The long answer, I'm going to get this off because I'm reading. The long answer is that quality companies have lower leverage, better ability to withstand hard landings, which we're apparently heading to, and most likely to receive flow in a soft landing. So if everything's okay, then quality companies are still going to get bought, no doubt about it. Tech layoffs are done ruthlessly, have been done ruthlessly, and the market appreciate it. So their ability to defend margins is relatively good. High return on equity, which is the quality companies have got a really good high ROE, return on equity. Return on equity is the net income over the average shareholder's equity. Put bluntly, since ROE is simply earnings over equity, if you increase the profit margin, you increase earnings. So increasing earnings without increasing equity is a domino-like effect on ROE, increasing that as well. So if you can sort of think about where I'm going from there. So if you can, if you're good at increasing and protecting your ROE, it means that you're good at protecting your margins and increasing your margins. Companies like that are going to be like gold in the year ahead. So there's that play. Moving on. China. This looks like a reopening. Mobility indicators in China are soaring. The number of passengers using the metro in Beijing, this is daily number of passengers using the metro in Beijing, which, I don't know, 2 weeks ago, it rose to a one-year high of nearly 1 million. Things are coming back online in China. We know that. That's not new information. However, I do feel like everything is now priced in China, which is funny because now, since I've put this presentation together, everything has been priced in and everything starts to have come off. Iron ore is sort of looking a bit ordinary. Well, that coffee is freezing. All right. China reopening. Yep, it has supported our commodities. We know this. Oil demand. Now, this is the interesting one here. The oil demand drag is set to rapidly close over the course of calendar year 2023. If this is right from Morgan Stanley, it means that oil has a big catch-up to do from the oil demand that they have. Play that as you want to play it. If you want to go in and dig up or whatever you can do, go nuts. If you want more information about it, then fine, you can be that guy too. But this is their this is their trend for oil demand. This won't change. China is still China. They don't suddenly just get up and decide to stop being China. This will not change. Where was I? So oil demand has got some catch up to do. And then we're going to talk about energy. Now, I'm a holder of energy. I'm probably going to add to my energy holdings over the next couple of days, maybe a couple of weeks, see how we go. No rush. Don't be a hero in this market. But these are the things that I want to talk about here. So BP defending its transition. So BP moved from a move to a renewable side of things, or more investment in renewables. Realized that the margins weren't great in that, and really started to pivot back to being, we're going to go back into the old school oil and gas. I understand it is important. Russia, cutting oil output by 500,000 barrels per day in March. Look, if that is still relevant, it is, but last time I checked that it was, although I haven't kept up with it today. Finally, Robert Rennie, good friend of ours, worthy of note, the consistent messages in terms of rising inventory across a wide range of industrial commodities. US crude inventory at the highest level since June 21. US gasoline, highest since March last year. And global copper stocks at their highest since September 21. Now, whether that's highs, so then they're going to come off from there, or that high is moving through, interesting to what to say. So energy sort of play it. I don't want to just be buying oil outright. I would really rather just own the energy companies. They're still cashed up bogans and lots of money to throw to shareholders, which is great. What do we got here? Active energy position. Yep. Next. Right. Coming to a close here. No matter what happens, do not forget that I like to put these this chart, and I've found a new one which is also good. These are all of the disasters that have ever been the biggest things in our entire history. This is the Dow Jones from one place to another, and it goes back. We've even updated coronavirus up here in 6. Look where it is. So we're just sort of back. All of these things always take place, and you can see that sometimes they go flat, sometimes they go flat, sometimes they go flat. I think that potentially we are in one of these little flattish periods where things sort of will just eke on. invest accordingly. That's why you need someone helping you. Right, and here's the S&P return since 1950. Fact. It is not possible, I'm going to say this, if you had bought any particular date in time, at any time, random time, dartboard, or picking it out, you can pick out anywhere you want. If you had bought the S&P 500, 20 years later, you're up. That's a fact. There's nothing around that. Don't ever forget that that is the case. You will always be up 20 years later if you just buy the market. Now, there's obviously a lot of things that sort of go around that, which market and underperformance, and everyone wants to talk about that sort of thing. However, the idea of just long-term, good, deep value investing for the most part for your portfolio will never be the wrong move. Now, moving on. I've got things that are happening here. Where am I going into the next one? Right. What do I think is the shakedown? 60-40. Long bonds. I don't even get a chance to get into bonds. I've done that many times before. Long bonds, go nuts. That's paying you just money in the bank to sit there risk-free. No reason why you wouldn't do that. The Chinese reopening, I think that it's already priced in, and it turns out it was. Thank you. Europe on any pullback, although I think that there is still value in Europe, and you could do there. And yeah, so buy Australia on the Chinese reopening, but again, I think it's already priced in. It wasn't when I did this presentation. Energy on big dips, go nuts. Global quality and defensives is where my play was this last week. Gee, I really wish I'd yelled this a bit louder last week. Get out of consumer discretionary. Don't chase FOMO. You will get blown up by it. There will be the way that this market will go with the up and downs. It will go, hey, it's great, everything's fine. There'll be people who charge into the market. They'll get blown up. And then when it comes back off, there will be the big shorts in the market that'll have to unwind. Wait, you know what I mean. And then it'll come back down. As it's coming back down, the shorts in the market will then get squeezed out as it comes back up again. And it will just play the same tape over and over again all through the year. That's my view anyway. Copper, I'm going to do... there was more of the presentation on copper that had to happen. This is the standard portfolio, which I was sort of running at the time. It was a couple of months ago, I suppose, that I was doing. Shares, property, international. Look, this is just a standard stock, standard ETF-based portfolio that we would run for a $500,000 account. Shares, property, international, Nasdaq. It's all just a good sort of stock standard portfolio. Nothing too amazing. If anything, probably it's underweight. This one would be underweight bonds. I'd probably want that to be about 40% up instead of 20 at the moment now. But you can't win them all. This is also based on what the client needed at the time. So this is just what I cut and pasted. Where are we? Oh yeah, we do superannuation and stuff like that. Look, that's how that goes. Hey, thanks very much for joining us on this one. I can't believe it took me a week to put this together. However, that's how that goes. If you've got any questions at all, please let me know. Click the whatever on the whatever. I don't even know if I'm going to have a thing there. It's there. And if you want more information, look, if you want someone to have a look at your super fund, we've got guys who could just look at your super fund and compare the pair and say, okay, this one is cheaper, this one is not. You'd be better off doing this sort of situation move and keep all the same sort of exposure. That portfolio that I showed you just then was one where they had exposure in a super fund and we just went, okay, we can replicate it and just do it all cheaper. So it's just pretty much the same exposure with no difference that was going on at all. We've just got someone to help them out and save them a fortune on their insurances. That's what we do. So if there's anything else that I can help you with that, then please let me know. If any of these themes were interesting to you, then be my guest. Please reach out. I love talking about this sort of stuff. So there you go. Again, I apologise, but at least I'm representing VFS with what I do. And I'll talk to you later. Have a good one.